So, welcome here, everybody. Thank you for joining us. Thank you for being on time. We appreciate having you here on the platform. My name is Shine Adeyemi. I believe you all know me by now. Been doing real estate full time for 9 years. It will be 10 years sometime in October of this year. I am here with Tom Cullen. Tom is going to be our co host today. Tom is my preferred lender. Of course, I do work with other lenders. However, Tom he stood out over the years, and we've been great partners when it comes to helping our clients, whether you are a buyer or a seller, an investor. We believe we have answers to helping you unlock whatever needs you have when it comes to real estate. Tom has been in the business for 15 plus years. Okay, so this is a combined almost 25 years worth of knowledge right here between us. And if you guys have any questions or concerns, we believe that we can, help you tackle any problems, any questions you might have today regarding real estate. It's 2024, it's a new year, and we believe that almost everyone we know that is an adult would have one or two real estate related goals that they want to accomplish this year. After Tom shares his PowerPoint, his presentation with you guys, we will take questions, right? So everyone is able to put in, you can comment in the chat with your questions or whatever you may have. Paul, thanks for joining us. Yeah, Paul is a great partner of mine as well. When it comes to real estate and things that some of our investors do, Tom is a partner that we have had for a few years. He initially moved from, I'm going to use you as an example, Tom, if you don't mind. So, I mean, Paul moved from Pennsylvania about 3 years ago, I believe. I helped him purchase his property here in Atlanta when he moved here. And then from, owning a property here, he started with property management, short-term rental. So he does Airbnb management and all that stuff. And over the years, we've cross-referred clients. He's brought clients to me that purchased and have their properties on Airbnb. And I've sent clients his way also. And this is the kind of partnership and synergy I would like to build with all of you guys that are here today joining us. Okay. So without any further ado, I think I'm gonna let you speak, Tom, and just take it from here.
Good evening. Pleasure to be here. We'll get this screen sharing set up, and then I'll pull up the PowerPoint. Shine and his clients, I love the lending business. I love to help people with their home ownership, whether it be a new first-time buyer or if they're investors and seasoned and looking for a rental property, we can accommodate those. We also have some commercial options too, just by the way, if somebody's interested in something that's commercial property or more than four family unit. So, but with that in mind, I will start out. I'm just going to give you a brief overview of the buying process as it stands today and some good information about the process so you're very aware of it, that it's not a big secret. Sean and I are very big on transparency with everything and making sure that you're well informed during the process and know exactly what the key parts of it are and keeping you informed and comfortable throughout the process. So with that in mind, decision making, are you ready to buy a home? There's different decisions you have to make. One is, and the purchase decision is looking at your particular situation. The main things we look for is your income, a steady income that we can document. You pay your bills on time, low to medium debt, which is your credit card usage, and your ability to repay. The credit report has a 7-year history, so it gives us an idea of your repayment responsibility, and we focus on the last 2 years specifically, and that's what the credit scores look at. So the benefits of home ownership are tax deductions. You have your interest deduction on your IRS 1040 or your 1098 deduction, which you don't get if you're renting. Stable housing costs. You're not going to see big rental increases based on the whims of the landlord, your landlord, and you're going to have an appreciation on your investment. That's a huge piece of it. We've seen some really big appreciation in the last couple of years. We see at least a 4 to 5% average per year appreciation. And so that equity you gain in your home, you can use that to step up and purchase something else, buy another primary residence or buy a rental property. So there's a lot of options with the equity that you gain. And of course, you control your property, meaning you can upgrade the property. Whatever you do, it's yours. You're never moving out of it. So if you add on to it or put in a new kitchen or a new bathroom, that's going to be your increase in the value of the property for as long as you own it. So that's another big benefit. So what is a mortgage? A mortgage is a loan that is secured by real estate. It is a loan that will be qualified in very different ways depending on the type of loan, but to identify the lending standards. And the underwriters, an actual human being will look at your loan and review it, and they'll look at the different criteria such as job stability, credit history, and your assets. Not only money that you might be putting down, but money that you might have saved up that you're not going to put down, but that makes you more attractive because after closing, you're going to have $100,000 in the bank, or you might have a retirement account. So all those things are important in the purchase and what we look for. If you want to buy a home, this is an example of a purchase. If you're looking to purchase, just want to give you an example. If a purchase price is $350,000, that would be a principal interest payment of about $2,258. That's based on roughly current interest rates with 720 credit score and 5% down. And taxes, that's going to be vary a lot. That number right there will vary based on where the property is located and what the assessment is, what upgrades have been done, if it's owner occupied or investment. So that can vary a lot, that number. Insurance too is based on current market. That's more up to you as the purchaser. You have the choice of where to get your insurance, what your deductible is, and those kind of things. And then PMI, or private mortgage insurance, is the insurance that's required if you put less than 20% down, and what it's for to prevent against foreclosure. So that money goes into a fund used to pay off any foreclosures where somebody's not able to make their payments anymore, and the bank has to take over the property. So that kind of gives you an idea of what makes up the payment. Again, if you put 20% down, you don't pay this number here. That number is a function of the loan amount and how much you borrow. So this is a huge stat right here that is very important. According to the National Association of Realtors, the net worth of a homeowner was about $300,000 more than that of a renter's of $8,000 in 2021. So that's about 40 times your net worth, meaning if I rent for 30 years and you buy one or more houses over a 30-year period, your net worth is going to be at least 40 times greater as a owner, because that's a huge savings vehicle just because you make your regular payments. So you're paying down the mortgage balance and also getting the increase in the value. So let's turn to the process of buying your first home. And this is really buying any home with a normal qualification with your regular documentation. You'll pre-qualify with a qualified mortgage lender, which would be me. You'll shop for your home with Shine, who is a more than qualified realtor. And then we work together closely in determining what you qualify for. And then Shine's going to make an offer on a property once you decide, after looking at different properties, which one you want to make an offer on. And then once the offer is accepted, you will have an inspection on the property to make sure the property you're getting what you expect. And then the appraisal is done, which is done by the lender to verify that the property seems to be worth at least equal to or greater than what you're paying for it, which is real important. So we get a second opinion, so to speak. And then you have the legal, which is to make sure the title is clear. And when you take ownership, that house is going to have no issues on the prior ownership. All the bills have been paid. There won't be any outstanding taxes or any sanitation fees or any liens or anything like that. So that's all taken care of. And then you go to closing, and you own the house. The title changes when you actually close on the loan. So that process is what it takes from the time of qualifying to purchase. You're making an offer. It can be anywhere from as little as we've closed in as little as 8 days up to, 30 days is certainly more than reasonable for a closing in the current market for sure. Why is it important to be pre-qualified? It's important so that you know with confidence what you can afford before you begin shopping for a home, to know exactly what the payment's going to look like and how much you want to spend, how much you can spend on the monthly payment. Also, it tells the sellers you're serious about buying, and that's very important in today's market because the sellers want to know that you've had your all your financials reviewed and that you're ready to close in a timely manner and that you're serious about purchasing. And then again, that goes with number 3, which is that you can make an offer and get into a house quickly. Once you have that, you have the confidence. If you find a house the next day, you're able to close, and there's not going to be anything that's going to cause you any delay or any concern. So the mortgage process itself, excuse me, the loan officer helps you in the first step of purchasing. The appraisal determines the value. The title work is done to prove that you can get property ownership. The prior owner has given you clear title, and there's nothing that they're going to owe. The underwriter is the person who qualifies you within the lender's company based on the program you selected, and those criteria will vary based on what type of loan you have. On a fully documented loan, you'll provide a very detailed amount of paperwork. On something where it's a possibly a rental only loan, you might only provide information on your credit and your current amount owed on the property or on the properties that you own, and it can be a little simpler than that. Then we provide the loan commitment after we've reviewed everything. We'll give you a loan commitment with the terms and conditions, your interest rate, your payment, all those things, so you know exactly what you're going to be closing on. And then when the closing comes, you'll have the funds transferred from us to the closing attorney wired, and the money that you're paying at closing will be included in that, in anything you're paying for earnest money and everything. And then once it closes, you'll get a servicing notification where you send your payments. Most everybody has online payments now, and those can be, you'll have your loan transferred oftentimes more than once. And no matter where your loan servicer is, you always pay the same principal and interest payment. Of course, taxes and insurance are going to vary based on each year, your premium and what the property taxes are from the county or the city. So the 5 keys that we have to home ownership are job stability, which is your 2-year history of jobs, your credit history, obviously, which is what your history is and what's included in your credit, along with your score. So that's going to tell us, your 7-year history of accounts that you're actively open and the ones that may have closed a year ago, or mortgages you may have had a couple years ago. We're also going to verify your current available assets that you have, not only, like I said, but for closing, but also for your savings and what you have after closing. And then the personal qualifications factors would go into your own situation with your income, your job, and your situation, if you have variable income, commission, things like that. And then, of course, the house is important too. You're going to do an inspection, we're going to do an appraisal, and the type of house you purchase matters a lot in terms of qualifying, whether it's a condo or a single family house or a multifamily or a townhome is going to determine things also as far as your qualification and what's required. The job, number one, on breaking down the job stability, is a 2-year history with the same line of work is ideal. You can have gaps up to 30 days typically, but you maybe have be a job where you work 6 months on and 6 months off. That's also not going to kick you out necessarily. But if there's many jobs, or a decrease in income instability, or, like I said, many gaps in income, that could be a problem, because ideally we're looking for 2 years with no gaps. Changing jobs a couple times is not a big deal, especially if you're increasing in income. And number two, the credit history score is you have 3 scores, and those are TransUnion, Equifax, and Experian. The score ranges from a 350 to an 850. They're used objectively, just purely based on your payment history. And the whole idea is to determine the likelihood of your repaying your debts. That's really what the whole point of it is. They have algorithms that determine that. A credit score of 500 indicates you maybe have a 50-50 probability of repaying debt. A 700 credit score indicates a probability of 70% probability of repaying debt. So obviously, the higher the credit score, the more the less risk is, and the better the terms and rates that are offered. So there is you are rewarded for your credit score and your repayment of your debt. Also, the other determinations are how much debt you currently have total. So if you have how many lines of open credit matter. Your credit cards are a big part of your credit score, how much you owe versus what your limit is on a credit card. So if you have a $10,000 credit card limit and you owe $100, that's excellent. If you have a $10,000 limit and you owe $9,500, then your score could be 40 points lower just based on that credit card usage, which goes to the number of credit cards and loans. And then inquiries will be a factor if there's a whole lot of inquiries recently that it looks like you're trying to obtain a whole bunch of credit. That can also impact your score negatively. So, of course, it's payment history per line of credit for each account that's open. It's the number of credit inquiries. Then the personal data goes back to what it has your employment history on there to some degree, and has your residence address history of where you've lived the last 7 years. There is some legal proceedings and bankruptcy and judgments. Most of those have been removed from the reports. They're done on what's called a background check nowadays. Those are typically not on your credit report, which is actually a benefit for your score. And then tax liens are typically not reported anymore either. So that's good news, although they will come up on the background. So available assets, that's the amount of money you have for down payment and closing costs for the home based on what you need to put down or what you may choose to put down. They're documented by your bank statements, your retirement accounts, your mutual funds. They cannot be borrowed by you unless they're disclosed as a loan. Gift funds are acceptable, and the gift funds can come from, a family member, a relative, and that money could, they could borrow that money, but you can't borrow it yourself. And there are down payment programs available. There's some state bond programs and a USDA if you're living in a very rural area, or a veterans loan for qualified veterans is 100% loan. Those are based on income, based on area. So that is a possibility also. And then the home buyer programs for first-time buyers, you have to have ownership or have not had any ownership for the last 3 years in a property to be considered a first-time buyer. So you could have owned 4, 5, 6 years ago, and that's okay. And the assistance can be in the form of a gift money for down payment, buying down interest rate, closing costs. They can be used for anything on the loan typically. You just get the buy downs, and the first time home buyer, again, no ownership for at least 3 years. And then for personal qualification is takes into account your actual pay stub and a 2-year history, your regular pay, which would be your base hourly or base salary, any regular overtime, any bonuses calculated, whether they're paid on a quarterly, semi-annual, or annual basis. If you have a 2-year history of part-time or second jobs, we would be able to use those too if you're working 2 jobs and have income. Pension, retirement accounts are also available. Social Security for any Social Security or a dependent Social Security is available for additional income. If you have child support, that's available. Also, if you have ongoing child support and your child is under the age of 15. It's got to be a continuation of at least 3 years. You may have a possibility of an investment payout if you have an annuity. And then regarding the big part of it is what your debt versus your income ratio is, which takes into account your total income over a year and then your total debt. We would do a division calculation of those. Typically 45 to 50% of your total income can be devoted to your current debt payments plus the new mortgage. And we're going to verify the funds have been in your account. If they're just recently came in, they're going to verify where they came from. If you had an inheritance or an insurance settlement or something like that, we'll make sure that that's your own money. And then verify the funds to close. The rental payment and mortgage paid on time. Sometimes we need to get that. Oftentimes we don't nowadays. But sometimes in a loan where there's some other factors that are questionable, we can get a payment history for 12 months, and that helps get the loan qualified. So on the number 5 on those criteria is the house qualification. That's where you'll get the inspection, through Shine, determine what the property needs. That's the in-depth inspection on the property. And then, going into all the details of the mechanicals, the electrical, HVAC, and the plumbing, along with the roof, the foundation, those major items. And then the appraisal is more looking at value. The appraiser is not going to go in and look at all those detailed items in the property. They're just going to make sure there's no major issues. They're going to turn on the lights and run the hot water and make sure the roof isn't falling in and there's not active leaks in the ceiling and things like that. So your inspection is what's going to really address your confidence in the property. And then you're going to get insurance based on that with the property, based on the area where the property is, obviously the value, the deductible that you might want on the property, and then the coverages that you want. And that's going to vary a lot these days from different insurance companies. It's not a set number anymore like it used to be. You might get one company insure you for $1,500 a year, another one might be $2,500. So we have options to advise you on in shopping that insurance. So then with that in mind, the different programs we have available, the overview of the programs that we have available in a general way, we have the Freddie Mac and Fannie Mae, which is considered your conventional ones here. And then you have Home Ready, which is a 3% down depending on income. And Home Possible, that's part of Freddie Mac's program. Again, depending on income and property area. And this is regarding the Refinance Now program, which is for refinances. We also have a home style renovation, which allows you to purchase a home and renovate it all in one loan. It's a pretty slick loan where if you find a house that needs work or you want to add on to it, you can do that all in one loan. And that also is great for a property that is in bad shape, that you can get it, use a mortgage loan to buy the property, because you can fix it up in there and it'll be up to the appraisal standards once it's completed. Also, one-time close construction loans, and we have two-time close also, where you have a construction loan from the ground up. So versus renovations existing, one-time close is a construction loan is from the ground up. And you'd have a vacant lot that you would purchase and then build a house on it. There's also non-qualified proper specialty products. Briefly, those are like you have the foreign national programs for people that do not have a U.S. green card or U.S. Social Security number. And then there's rental property income only loans. There are some no income verification loans and some bank statement loans where if you don't have good income shown on your tax returns, you can do a bank statement deposit loan. And all those are going to require more money down, anywhere from 10 to 25% or more down, depending on the credit score and the type of loan. And buy downs are where you buy an interest rate down if you wanted to have a lower starting rate, possibly where you're looking at refinancing down the road. That's an option. There's also just buying the rate down itself with your own funds or money from the seller. So you have those options. And then the other program is FHA, which is the Federal Housing Authority. That is a federally backed loan backed by the U.S. taxpayer. And that's got a little more leeway and flexibility in the qualifying. U.S. Department of Agriculture is the loan I mentioned with the rural properties like that are not in any town area. So they're going to be out there basically outside the city limits of some town. So it wouldn't even, you could have a town in South Georgia that had 20,000 people, but that city limits, it would not be available. But outside town, that would be available. And we have a map that shows all that. And then the VA is the veterans loans for people that are or currently are or were active or prior veterans serving in the armed forces. And then jumbo is any loan over 766,000 right now. That's the limit on a conventional here, FHA or Fannie Mae. So anything where you're looking something in the 800 to 900 and above, that would be a jumbo or non-conforming loan. So a little bit about us with Princeton Mortgage. We have the effortless mortgage. We try to make it as effortless as possible. We don't want you to have a bad experience. So we foster an environment where motivated people can thrive, treat everybody well, our customers, our realtors, of course, our employees. We're always available to answer any questions and help out throughout the process. And our goal is to deliver value, to provide, good service, for your money. So much so that we have the Princeton Promise that if for any reason you're not happy with the loan, something happened on it, bad communication, issues with closing, delays, et cetera, we give you $1,000 at closing. So that's how much we believe in being able to deliver on the mortgage on a timely manner and also a smooth and happy closing. So with that in mind, we'll answer any questions. I'll turn it back over to Shine. We can field and answer any questions you might have. And it was a pleasure, and I look forward to working with any of y'all. I'm always available for any questions. I'm a resource for anything you might need in terms of information on real estate and the market, and I'll give you my take on interest rates and home values and any of that I can help you with and give you my qualified opinion.
Tom, again, thank you for this information. That's amazing information that you shared. I will start reading some of these messages, right? So the first one says, does the PMI stay with the loan for 30 years or does it fall after a certain number of years?
So the mortgage insurance falls off after if you pay the mortgage down 20% down to 80% of the original amortization, you can get it removed just because of doing that. Also, you can get it removed if you have, say you have bought a house, you put 10% down, and then in 4 or 5 years, it's now, you've paid it down, say 5%, and now it's worth 5% more than it was. So for example, you have a house you buy for 300, now it's worth 400. You paid it down, you can get that house, get that removed. So the short answer is yes, it's not on there for a lifetime on a conventional loan. On an FHA loan, it is. So an FHA loan, the only way to remove it is to refinance out of that to a conventional loan.
Awesome. Thank you for the answer. So to answer your question, Jane, if it's an FHA loan, like Tom said, it stays with the loan unless you refinance out of that loan. But if it's a conventional loan and maybe you put down only 5% or 10% or 15%, then once you have about 20% worth of equity in the property, or you've paid off your loan up to 20% of the worth of the property, that PMI drops. But you would have to contact the mortgage company. That's the funny part. If you don't contact them, they will keep collecting your monthly payments and act like you haven't done that. Am I correct, Tom?
Yes, correct. You have to initiate that. They're probably not going to, broadcast that, but it's something that I always recommend everybody look at, and they'll do the appraisal typically once it's initiated, but it's definitely something that you want to keep in mind when down the road and check on that and, start looking at that. And they're going to want it typically at least 1 year on the books, no matter what. And then after 1 year, they would look into getting that removed. But again, that's going to be you keeping track of that, like just exactly like Shine said. They're not going to call you up and have you remove it.
Awesome. Now, someone asked if we do work across all U.S. states. I did answer and said yes. I did answer for myself. So Tom, you can also answer. However, on my own end, yes, I am licensed to, my team is licensed to operate in the state of Georgia. And so this is where we are based and we work out of the state of Georgia. However, we do have partners across all 50 states of the US that do have the same kind of work ethic as my team. And so, I mean, 2 months ago, we did help someone in Phoenix, Arizona purchase an $800,000 house. We help people in Houston, New York, and all those cities. So no matter where you are, if you are looking for a reputable team to work with, we have partners there that will do exactly the same job that we do here in Georgia, and we stay on top of the deal until you guys close and all that stuff. Okay. Tom, on your end, would you please answer that if you can help them in other states?
Yeah, we lend in all 50 states. We have a reciprocal relationship with other people within Princeton Mortgage that handle. We have a national desk, basically a national loan officer that handles any of those transactions in other states, so we can get those done. I think we may not be in like Alaska or Hawaii, probably, but we definitely have access. I have access to be able to handle that and oversee that wherever you're purchasing, if it's not in Georgia.
Awesome. Thank you. Another question says, what if I don't have a job? Can I still qualify for a loan?
Only if you have, so if you don't have a job, if you have other source of income, if you have a pension or
business.
There's an asset what they call an asset dissipation loan, where if you have a serious amount of assets, they will use an annuity stream of that as a payment option also. But typically, any of the lower down payment programs, FHA or the conventional, you'll need to have prove the income through a job or again a pension or something.
Awesome. Someone asked, let me see, is there any way I can reduce my annual property tax if I paid cash for my house? So pretty much every year, you know how taxes increase. Let me answer from my own experience, and then Tom can continue. To me, I tell people it's this way, and it happened. It's the same thing with me, right? I'm in the same boat as you guys. Every year you get the new tax bill from the government, and your tax has increased. Well, we don't like to pay it. There is an increase, but the good thing is it's good news to you because it just says that your area, your community, your city is, your property is worth more than it was last year. And so when taxes go up, it means that, you have equity in your property. And I believe that if you want to reduce it to some extent, you can apply for something called a homestead exemption. If you live in the property, if it's your primary place, your primary residence, you can apply for a homestead exemption, and they kind of take some percentage of that rate.
Yeah, so that's it's based on your occupancy, but yeah, the property taxes are completely separate from whether you have a loan or own the house free and clear.
Awesome. Can you provide mortgage to finance a building outside Georgia? I think Tom answered that question, and the answer is yes, correct?
Correct. Yes, I have lending options nationwide.
Awesome. And then Medix is asking, what's the difference between a HELOC and a Refi?
A HELOC is typically, that's an equity line. I characterize that as a credit card that's attached to your house. That's typically a second mortgage that is attached to your property. So you may have a $200,000 mortgage, a first mortgage that you're paying on that you used to buy the house. Then you may have an equity line of additional $50,000 line of credit that you have access to that you can borrow on and pay back to like a credit card, and that's available. People use that to, upgrade the property or maybe to buy another property, to buy an investment property but the refinance is a full refinance of your first mortgage. That's what the refi is. The HELOC is a secondary mortgage that doesn't affect the first mortgage. So if you have a property that you have a good interest rate on, but you have a lot of equity, it may make sense to go ahead and do an equity line for additional amount of money, depending on how much more you need. Well, we do an assessment on that and see what makes the best sense, but that's the difference. So refinance is first mortgage, equity line is a new loan that you take out as a credit card tied to your house, basically.
And let me ask, Tom, with a HELOC, you have to use that like you said, credit card, the money you get right from the equity of your property, you normally have to use it towards improvements in the house. Is that, 100% right, or it doesn't really matter? Like, I think people can pull out that equity and use it towards something else. Is that correct?
Yes, they can use that to they can pull out 100,000 and they could take 20,000 to pay off their auto loan and 20,000 to pay off credit cards, and the other 60,000 they could use to put a down payment on a rental property, for example. So it's up to you, or you could go vacation, go on a trip to Zimbabwe if you wanted to. or go to Nigeria, right?
I know, right? And Tom has been to Zimbabwe. Tom used to be on missionary trips to Zimbabwe, and that's why he's using that country as an example. Okay. All right. Another question from Cullen. So this person is trying to get a construction loan on a primary residence or multi-family investment property, and the person is asking, what is the percentage required?
So that will depend on if you're going to live in the property, that would make a big difference. So starting from the best case scenario, if you're living in the property, it's going to be a primary residence. You could put as little as 5% down on a one-time closed construction to permanent on a single one unit. Above that, you're probably going to be more of a commercial loan in order to do that, because most of the bank loans are limited to a single family living in the property, primary residence. That said, I do have other programs for folks that are doing a multifamily. It would be considered more of a commercial program. And then most of those are going to probably be at least, probably 20% down on like a quadruplex. So if the land is 100 and the quadruplex is 300,000, that's a $400,000 total build cost. You'd have to have at least 20% down on that, and they're going to look for very strong borrower and qualification for the builder. A lot of those, they love to have honestly, they like to have the person who's building it be the one that's also the person on the note. So they've gotten, but anyway, that is available, and it's definitely case by case. When you get into those type of loans, it's very much a matter of what your particular personal profile is and your down payment and that kind of thing.
Awesome. Thank you, Tom. Someone asked, what would I need to qualify for a construction loan for quadruplex build from ground up? So they're looking to build from ground up. And what kind of loan should he be looking at from the list presented in your presentation, Tom?
Actually, that loan, I mentioned commercial because that wasn't in the list, but that's what you'd be looking at is a commercial loan, because it's a quadruplex. So they would treat that as a rental property, an investment property, which is almost, think of it like it's an income producing, just like a strip mall. If you're buying a restaurant or a daycare, that's how they're going to look at it. So that's the type of loan, and that's going to be based on. So I do the commercial lending also and have options for that. And again, it's going to be based on credit score, on your experience, if you built from the ground up recently, how much money you have to put down. Typically on something like that, it's going to be 20%. And then if you have additional money in the bank, if you have a building experience or a qualified builder, then that would be a big consideration. So if it's a first time deal and you're trying to do it, it's going to be, you might even have the builder go with you on the note, and then they want me to be able to do a takeout loan, what they call a permanent loan, when you're complete. So, and those are very, very customized.
Each
situation is different.
Awesome. Thank you, Tom. Someone is asking, for someone who does business, what is the requirement to buy a home? So this person does business, is a business owner, and wants to know what the requirement is to buy a home. And Tom, I think you can also just let them know what the minimum credit looks like right now to qualify for a home purchase, whether you're a business owner or a W-2 income earner.
Yeah, so I'd say so if you have taxable income, you can prove. That's the first key, is what you show on your taxes after expenses, and whether you're a S corp or a Schedule C. So if you show taxes and have enough income to qualify with your tax returns, then you can put down as little as 3.5% on FHA, or 3 to 5% on conventional, and I can review that with your tax returns. Alternatively, if you have a high credit score, which would be up over and above a 680, would be the bank statement loan. And that's where you have, if you have a separate or even your personal account that all your money goes through an account. Let's say you put $120,000 of new deposits through your account the last 12 months, then we use $10,000 as a starting point for your income, 120,000 divided by 12, and then that would require at least 10% down.
Okay, so you are saying that this person can use a bank statement loan if their credit is at least 680, correct? And you use the deposits from their bank statements to ascertain their monthly income, and based on the monthly income, they will still need to put out about 10% to purchase a property, correct?
Correct.
All right. So you said good income is 680 credit. I mean, good credit is 680 and up. However, for the minimum credit score, what would it be that someone needs to have in order to be able to purchase? Let's assume that they are a W-2 income earner or something.
So there's an option depending on some other qualifications down to a 580 credit score, but there'll be additional requirements at that score. Beyond they'll sometimes want a rental history. They'll want additional money in savings beyond closing, after closing. So there are some additional requirements, but that's as low as a 580 for FHA available.
Awesome. There's another question here that says, can someone get approved for a loan to buy land? Yes, you can. You can purchase land using a loan. However, in my opinion, most people, even the lender, wants you to use your cash to buy land and then get a loan to construct, to build. Am I right, Tom?
Yes, there is a construction or a land only what they call a lot loan, but it's usually they're at least 30 to 40% down, and probably 10, 11, 12% rate. There used to be a lot of lot loans, but now they're very not that many. So if you had that money to put down, then you could tie up the lot and do that for a short term, but it wouldn't probably make sense to buy a lot like that and for a long term solution. You don't want to try to do it all in one with purchase the land and do the construction all at once.
Are there many lenders out there that will do a loan for the purchase of land, Tom? And do you do it?
Yes, we do have a couple of outlets for that do the lot loans. We have one at 35% down and 40% down. So if you had a lot you were going to purchase and it was up for $100,000 purchase, you'd have to put down $35,000 to $40,000, and then that money would be also credited to you when you did the construction of the property. But that's what it would take to get that purchase along with required closing costs.
And is that a 30-year loan? Do you have the 30-year option, or it's like 5 years ARM or a fixed rate?
Typically right now they're a 20-year amortization, 20-year or 25-year loan.
Okay, cool. Quick one before I continue with those questions, right? One of the biggest topics right now, Tom, is, and everybody listening, is foreign national loans, and I have a bunch of folks here that don't even live in the US, but they are interested in investing in the US. And it's important that everybody hears this, because to me, based on my experience, I've been doing this for a while, and I will tell you that the foreign national loan, there are loans for foreign nationals. And what that means is you do not live in this country, you live abroad. You most likely make your money abroad, right? You make your money in Africa, you make your money in Europe or whatever. You don't even have a social security number here, but you want to invest in the US. You can do it. And there is a loan avenue for you to be able to purchase investment property and do that, not really putting all your 100% cash on it. Based on my experience, the foreign national loan is the easiest loan that we do. It's the easiest loan that the bank would furnish. Folks back home don't even believe it when I tell them, listen, you can buy real estate with a foreign national loan. But think about it. If you're putting down 30% or 35% on the purchase of a $500,000 property here, where is the property? Is the property in Africa or is here in the US? It is here. So the lender is fine with you putting down 30, 35%, and they would lend you the remaining 65, 70%. But guess what? If you are late on your payments, it's easy for them to just take back their property and sell it and get their money back. They're not losing anything. Now, the criteria that they normally follow, right, to furnish those loans is you are not working here, you are not making your money here. You just need to be able to show them that you have the down payment money sitting in a bank somewhere. Whether the bank is here in the US or abroad, it doesn't matter. But they need bank statements to show that you have that income to put. I mean, you have the down payment to put down. And then the next piece of information that the lender needs from you is your passport, your foreign passport, and that's fine. You don't even need a visa to be able to purchase that kind of property because you don't need to be here physically. I've closed deals for people that live back home in Nigeria and they've never stepped foot in the US. They've never been here and they own real estate and they are collecting rent on a monthly basis from tenants that live in the property while the property appreciates in value. So I'm putting that out there because I know a bunch of you guys have folks, of course, back home and all over the world. Let them know that the foreign national loan is one of the easiest loans that we furnish, and I'm always excited to talk about it because you don't make your money here and you don't even have a credit score, credit system here or social security. The lender does not, there's not much scrutiny, to furnish that loan. It's pretty easy. All right. Let me continue with the next question from Eric. Tom, Eric is saying that he missed what you said about the PMI that drops off after 20%. So if you can please repeat that part.
So what you do is go out to Zillow or Redfin or whatever, see what your house, what a fair market house, what your house is worth today. That's one thing you want to monitor, and then look at what your mortgage balance is. And if there's a 20% difference in there, if you know your house, it looks like it's a good fair market value is, say, for example, 300,000, and then your balance on your mortgage is 240, that's 80% of 300, then that would I would call my current servicer and say, hey, how do I go about looking at getting my mortgage insurance removed? And they'll do an analysis of that. They'll look at your amortization, your payment history, all that, and then they'll if they agree, they'll have you do an appraisal. They'll choose the appraiser, but they'll have an appraisal done, and if it meets that criteria, then you can do that. You also have the ability within that transaction usually to put more money to it. So if that was something where, hey, you were a little short, they would let you put additional money to get to that threshold. But that's the way you would do it, and it would be typically at least a year after you've owned the property. This extenuating circumstance, they're going to want you to make at least 12 payments on time first.
Cool. Tom, quick question. Can one person have two FHA loans?
There's a hardship where their job took them to another area and they needed to get another FHA loan. There are some limited options for that, but typically, no, it's a primary residence loan. So if they have an FHA loan right now, they would either need to be able to qualify for conventional for another purchase or refinance out of that FHA loan and then have that become conventional, and then they could purchase with an FHA.
Or use the spouse. So right now, if you have an FHA loan on your property and that FHA loan is in the name of the husband, for example, well, if the wife has all it takes in terms of requirements to qualify for a loan, you guys can get another FHA loan using your spouse. Correct, Tom?
Yes, we can do. So in that scenario, the FHA loan is in the wife's name, for example, and the husband has the ability to qualify credit and income on his own. Then they could have that. They can. The FHA loan would not stop them from buying a conventional. They would be then either selling that FHA or whatever, or renting it out. So that's definitely possible.
Awesome. Madam Afyong is asking, if you already bought a house as a foreign national and now you are a resident of the US, and how do you convert to the regular loan for lower interest? So let's assume she owns property, right? With a foreign national loan, Tom, you know that the foreign national loan is slightly higher in terms of interest rate than the regular conventional. Now she is asking, how can she convert the current loan to a regular conventional loan and take advantage of the lower interest rate?
Yeah, so if she has either her permanent resident alien or social security number, permanent, or U.S. citizen, then you would refinance into either FHA or a conventional loan. I would think conventional if you have decent credit scores, because conventional with low equity or with a lot of equity, so if you have 30-40% equity, they'll conventional will go down to as low as a 620 credit score. The only negative is that 620 is going to have a higher interest rate. Because it's a 620 score. But if your credit scores are good, you have U.S. credit and U.S. income and green card or U.S. citizen, you would refinance to get that lower rate.
Good answer, Tom. Let me ask, based on the requirements, right? So now, if the person is going from a foreign national loan to a conventional loan, so aside the credit that you just spoke about, would you also check like their tax returns for the last 2 years? Would you check their current maybe pay stubs or something to show that they have income coming in, or those things will not apply?
Yeah, they would apply. So if you're now here and you're working here and all that U.S. based, then that would be the same requirements that somebody had been living here for 20 years. So, and even possibly in a 1 year situation where you came over, got your green card last year, and now you're working for a U.S. company or have a U.S. business, and you qualify the income on your tax returns or your W-2s. Yeah, you're good. That's what you would need for income.
Awesome. Thank you, sir. Do you provide mortgage for investment properties or secondary home? Yes, Tom does that. Tom does investment properties and secondary homes all day, every day. I have clients that we refer to Tom every time. We did a bunch of those last year, and we are on track to do those this year as well. Okay, so please reach out to Tom. At the end of all of this also, I would be sending an email to you guys with Tom's information, and those of you that have my number can easily reach out to me to get Tom's information as well. Okay. Mr. Robert is asking, do you need to report improvements made to your house, like completing your basement, to the county to improve the worth of your house? Or do you keep the information to yourself so as not to increase your taxes? What do you advise? That's a good question, man. And trust me, it's a tricky question and a good one. I've seen it both ways, where people don't want to report it because, just like you said, you know that it will increase the value of your property and now your tax will go up. But the risk in doing that is, okay, you have renovated your house, you have finished your basement, you are not telling the county, you didn't get permits to finish your basement. When it comes time to sell, correct me if I'm wrong, Tom, when it comes time to sell, if you used to have a 3-bedroom with 2 baths on the main floor, and now you have another 2 bedrooms and 2 baths downstairs, when I want to sell that property, list that property on your behalf, I am not going to be able to display on the MLS that it has 5 bedrooms and 4 bathrooms now, because you don't have a permit, or the county doesn't recognize that. Is that correct, Tom?
It's definitely a judgment call. I would definitely. So first of all, if you're just doing cosmetic work to the house, the existing property, you're not adding on and doing anything, then there's no reason besides a general repair permit, and that's not going to trigger your taxes, a property tax increase. But if you do finish a basement, or of course add on either out the side or up, add on a second story or whatever, then if you pull a permit, that's what triggers the assessment besides just a normal tax assessment. And if you can roll the dice and not do that and try to do it all under the radar, but the other risk you run is that if it hasn't been properly permitted and somebody's wanting to buy that property and that history on there is not showing up there with the appraisal, and unless they're paying cash for the house, you may have a problem selling that house with those upgrades. So the negative is, yes, you'll have to pay higher property taxes. But let me tell you this, a tax assessment is for heated and cooled space above ground. So if I have a house and I finish a basement, I've got say I got a ranch, it's 2,000 square feet. I've got a basement that I'm going to finish for 2,000 square feet. that is considered below grade. So it's not given the same value and it's not taxed at the same level as above grade. So that will not make a big impact on your taxes. If you add on to a house and put a second story or anything above grade, which means above the dirt, then that's gonna increase your value.
Awesome. Thank you, Tom. Mark is asking, how can I get two FHA loans? You cannot, right? You just did say that people cannot. Is that what it is?
Yeah, that's not available unless there's like a specific situation with a family situation or a job change. There are some unique criteria, and it's possible. I think I've done one in my time, and that was because of a hardship. They had to move, and the job change, but there's still geographic limits and all that. So it's very difficult to do. And I can certainly pull up those exceptions, but there are only a couple of very rare exceptions.
Awesome. Ellie is asking, if I need to do custom build on my own land, can the land value be used toward the down payment? How soon can the loan payment be scheduled, assuming that it would take 8 months for the house to be completed?
Yep, we give you credit for the equity in the land. So if you bought the land, a couple of years ago, whatever, they'll do a fair market assessment of the land, and whatever that land value is, they'll give you credit for that as money in the deal, as if it were actually. So if the land is worth $100,000, they're going to give you credit for that $100,000 that the lot is fair market value, and then you would get a contractor, a builder, plans, specifications, cost breakdown, budget, all that, and then get that house built, and they'll include that in there, and it's treated like a refinance. You're refinancing the lot into a new home with the construction of the home added onto it. So that's definitely doable. I'm doing one of those right now.
So to answer his question, you said that you guys would calculate the value and add it back. You subtract it from whatever the construction loan is right now. Is that what you are saying? Or does that mean that it can be used as a down payment towards the construction?
It can be used as a down payment. So as long as the house, so in that scenario, say the house costs $300,000 to build, yes, and then you have $100,000 value of your current lot that you own free and clear. That's 25% of 400,000. So 100 plus 300 is 400,000 total. You have 100,000 of that is your own land value that you already paid for, or the current value. So that's 25% down right there. So with that scenario, with good credit scores, you wouldn't have to put any money down in order to build a house. You could build the house without any money.
Awesome. What is the typical interest rate for foreign nationals? So to answer your question, Cullen, in my opinion, foreign national loans are usually about 1.5 to 2.5% higher than whatever the current loan rates are. So if a U.S. citizen can buy real estate right now at, Tom, we are around 5 point something percent, 6% right now, correct?
Right now on a 30-year fix with you're probably more like around 7-ish, 7. Okay. So you'd be at somewhere in that range, depending on if you put paid down or anything.
Yeah. So if a citizen is paying 7% on conventional right now, for a foreign national, you're looking at maybe around 8.5 to 9%. It's usually somewhere between 1.5 and like 2.5% higher than the traditional mortgage. Okay. Can you break down what a HELOC is? Victor is asking about a HELOC.
Yeah, that's a mortgage tied to your house, a second mortgage or equity line, and it's just a loan where you can open up a line of credit, basically a credit card with a limit of say $50,000. It's dependent on your credit scores and your equity in the property. So what they do is they take the value of your property times a percentage. Maybe they go up to, with good credit, they go to 90%. And then, so say your house is worth $400,000, 90% of that is $360,000, and you owe $300,000 on your first mortgage. They would give you a line of credit of $60,000 that you would have to available to borrow and it's typically, they're all different types of equity lines, but typically it's got a 10-year open line of credit, and then after 10 years it turns into if it's still open, it turns into a 20-year amortization on whatever that balance is that is still owed.
Anna says, can I delay reporting my home improvement until I want to sell? So let's assume he already improved his home, right? He feels like he doesn't want to report it until he's ready to sell. Is that smart? Is that cool?
Reporting it is fine. The issue on the permitting and that has already happened. So it's really case by case that there may not be any issue. They may not check the permitting, may not be noted by the appraiser, but it's definitely potential that they could pull the permitting, and though you can't do it after the fact. So if it wasn't permitted, then you really can't go back and permit something if you've already completed it. So if the basement's now completed without a permit, if that's what you're doing, then you're basically just going to be looking at selling it at that point. If you sell and somebody needs a loan, what that buyer's lender wants to do, what the appraiser knows, what the lender thinks. It may go sail right through and be no big deal. It's not a given that they're going to. Now on an addition or something, that's a different story. If they see it wasn't permitted and check the addition on the what's been changed since you've owned it, that's more than likely going to be a problem.
That would be sticky. All right. So that question you just answered ties into the next one, which is what if the basement is now completed without a permit and you want to sell? What do you do? And to answer that question, Jane, I actually had a client who sold in Lawrenceville, I think 3-4 years ago, during the pandemic or whatever, and they had a finished basement that wasn't permitted, and it was 3 bedrooms that they got out of the basement with a movie room, a living room, and I think 2 bathrooms. We sold it, and we sold it at the value that I thought it was worth at that time. It appraised. The appraiser didn't have a problem with the work that was done in the basement, even though they didn't have a permit. So, like Tom said, to answer your question, I think it's a hit and miss. Some appraisers representing the bank would probe more into if you have a permit or if you didn't get a permit when you completed the basement, while some appraisers, I guess, will not probe more into that. But if you put a house on the market and your buyer is a cash buyer, you shouldn't have any issues with that, because cash buyers will not even bother doing an appraisal and all that stuff. Correct?
100%. Shine's exactly right. If the workmanship is good, then their chances are high with the basement completion that you're not going to have a problem. I'd say that's a pretty high probability that will be okay. But if they go in there and they say that, there's the drywall's tore up or there's a leak in the workmanship is there's exposed, still no ceiling in there and things like that, then that would be just a normal appraisal issue. But otherwise, I've done the same thing where I haven't had any issue, even though it wasn't permitted, because the finished basement's a little different.
Awesome. Larry's asking, how about if a foreign buyer is paying cash in full for the property? I think you are asking about that with reference to what we were discussing earlier in terms of having a basement without a permit. If that is what your question is about, then yeah, like we said, it's not a problem if. Oh, okay. So please clarify, Larry. If you are purchasing a property cash.
Yeah, you can buy it. You can pay cash, no problem. As a foreign buyer, you're paying cash. You'll get all the documentation. And
foreign national paying cash. Yeah, no problems at all, man. All day, every day, you can buy real estate paying cash as a foreign national. Nobody's disturbing you. That's fine. That's the best route. That's what I would like as a real estate agent. Listen, just bring your cash and let's buy. But I want to put some cheese in Tom's pocket too. So loans are not bad. Don't get me wrong.
Right.
Tom, I had a question from someone the other day, and they were like, listen, I have a fixed mortgage loan. So they have a 30-year loan. And you know how you get a 30-year fixed mortgage loan? Your mortgage, your monthly mortgage is made up of your principal, your interest, your taxes, and your insurance, correct? So they bought a property 2 years ago, and every year they get a tax bill. The tax bill is higher. And every year the lender sends them a letter to say, hey, your mortgage has increased a little bit. And this kind of threw them off like, okay, I thought I signed up for a fixed mortgage rate? Why is my mortgage getting higher every year? Can you explain that part?
Yeah, so the principal and interest, if you have a 30-year fixed loan, that means it's a fixed interest rate. That's never going to change. So that component of your payment, the principal and interest, is not going to change on your loan. But all of us are subject to whatever the change is in our insurance or the property taxes based on what the county's new assessment is. So we're always going to be subject to that change in our payment because those amounts are going to almost always, especially the taxes, are going to change every year.
Awesome. Thank you so much. So, guys, I'm leaving the floor to anyone that wants to talk or ask questions. We did spend a ton of our time speaking about mortgages, which we believe you guys need. It's a big part of investing in real estate here in the country. If anyone has questions related to real estate or anything at all you want to discuss, feel free to push that to us. Otherwise, it looks like the meeting is coming to an end. And listen, guys, this is our first of many for this year. So I'm starting this, and my first guest co-host on this is Tom, our preferred lender. Next month, I'm going to be having another one, most likely with one of our vendors, our partners that I work with, possibly a home inspector or a home warranty agent or whatever it is. I would let you guys know in advance via email and social media. Please tune in. We want to make this consistent every month and see where, how we can just be of value to you guys and provide information. Okay. You are welcome, guys. Thanks for joining us. We appreciate you guys waiting till the end. Tom, today, with a mortgage scenario today, if someone is looking to purchase today, what should they be looking at? What does the interest rate scenario look like right now?
So right now you're looking at, depending on what they call buying down the rate, paying a little bit more to get a lower rate. You'd be looking at anywhere from probably 6.5 to 7.5. Determinant factor is your credit score. So on a 740 credit score, which is there'd be no adjustments. That's going to be probably closer to the 7 to 6.875 range, without any points. And then on FHA, it's going to depend. That they're not as credit score specific, but that will depend on a little bit on credit score. And that rate's probably in the low sevens, also in the high sixes, with good credit scores. So that's kind of where the market is on the low end. The general prognostication is for the rates to ease a little bit. We expect them to decrease a little bit over the next 12 months. Who knows? But that's kind of what the general consensus is. And I monitor all the economic data. Like tomorrow, CPI, the Consumer Price Index, comes out. So that we'll see how the inflation looks. But there's a general, they hit kind of a high point about 2 or 3 months ago. They look like they're going to start ticking down.
Awesome. Tom, I have a good question for you. So we moved to Atlanta from New York in 2012, right? And at the time we moved in 2012, trust me, I was seeing properties at $80,000, $60,000 with a pool in the backyard, like a large swimming pool in the backyard in Decatur. And these houses were going for 60 grand. So every now and then I get folks that reach out to me and they're like, hey, I live in a state that, where real estate is so expensive. I'm looking to invest in Georgia, and just find me one of those $30,000, $40,000 properties, like those properties were in 2009 and 8 during the subprime mortgage crisis. My question to you is, do you ever see the real estate atmosphere going down that route again? So our average prices right now are around $350,000. Do you ever think real estate in the US, in Atlanta specific now, will get there, something in the $100,000 price point? Would the market ever drop that low, in your opinion?
No, I think those days are gone, forever. Always real estate appreciates. Even in the last I think it's the last 17 recessions, only one time, if you even had a recession, only one time did house prices drop even during a recession, and that was only by about 3%. And so they're definitely going to continue to increase. And Atlanta was a cheaper market for many years, but over the last 5 to 6 years, it's really caught up. And there's just a nationwide shortage of houses, inventory in houses, new and existing homes versus what they call home creation and people looking for houses. There's been a much higher demand and supply since about 1996, and that hasn't eased, hasn't slowed at all. So it's definitely an upward trend for sure on the housing prices. And that being said, it's definitely wise, as I said, that that net worth, you definitely want to look at getting into a property. It's never a bad time to purchase, as long as you make a purchase and you'll buy it at a fair market price today, and you can comfortably afford the payment. Which we will, Sean and I will make sure of that. And Sean's going to make sure that you don't overpay for a property. But it's definitely, not going to go anywhere. The prices don't seem to be, they're not going to be any major correction of any sort.
That's amazing. Thanks, Tom. And that's true, guys. You can never overpay for a property in this market and in this country, especially if you have a lender involved. Okay, if you are buying a property and it is being sold cash, and you are buying it cash, and you do not want to pay extra to get an independent appraiser to give you a fair market value of that property, then yeah, there is a possibility that you might overpay. Okay, however, if someone is selling property, real estate, and we go on that contract to purchase that property, and there is a loan attached to your purchase, the lender would always send their appraiser to evaluate the property and see what they think the fair market value is for that property. The lender is not going to release their part of the 95% payment or 90% loan to value unless they know that that property is worth what we are under contract for. So I've seen a ton of situations where we go on that contract, my clients think we are possibly overpaying or whatever, and then the appraisal report comes back and the house is actually worth more than we are under contract for. And what that means is you just built instant equity in that property. If you're under contract for $500,000 and the bank's appraisal comes back and tells the bank that they think that house is worth $540,000, that's $40,000 equity that you have in that property. And also we've seen situations where we do an appraisal and then the bank thinks that the house is worth less than the price that we are under contract for. And there's nothing wrong with that. If the price is worth less than what we are under contract for, we present the appraisal report to the seller and hope that the seller would come down to the price to match the appraisal value. That way you are not overpaying and we still continue with the deal. If a seller refuses to continue with the deal, you will have to back out, terminate. However, you will get your deposit back, you get your earnest money back. Okay, so 10 out of 10 times I haven't had a buyer overpay for a property, in my opinion. And so guys, thank you so much for tonight. We appreciate you guys joining us. If there is no further question, I would think that we have come to the end of this presentation. And like I said, I'll see you during the next one. You guys have a great evening. Tom, thank you so much for joining us. I appreciate you, and I look forward to doing way more business with you. Cheers to that.
Yeah, amen.
Yes, sir. All righty. Good night, everybody. Bye-bye.